Good afternoon. Happy Thursday before Labor Day weekend. Hope you are doing well and getting ready for a nice holiday weekend, hopefully in the sun. We got a lot to cover here this week. We got Jackson Hole last Friday, or the Fed's comments at Jackson Hole certainly did not disappoint, or I guess maybe actually it did. Plus, we've got a jobs week preview here, which is extremely important. Last jobs number before the Fed makes their decision coming up here in just a couple of weeks. So very, very important stuff coming up. We'll kind of give a preview. ADP employment number came back out this Wednesday, and then a preview into what we may see tomorrow on Friday for non-farms payrolls. Again, we got Labor Day coming up here. So as a quick reminder, first off, enjoy your Labor Day. Second off, markets will be closed on Monday, which after the Fed comments at Jackson Hole may be a nice little breather. So here we are. It's Thursday before Labor Day weekend, and let's start with the Fed. So the Fed came out on Friday. Fed Chair Powell had shared at Jackson Hole that basically they are going to be aggressive. You know, he didn't really say anything different than what we had been told the last month or so leading up to this. But for whatever reason, the markets really didn't seem to believe this until Friday. And since then, we've seen a big drop. Now, I think part of that is the Jackson Hole comments. I think also part of it is some legislation changes that are kind of happening now and some costs that may be involved there too. But, you know, we've seen since Friday, we had, you know, August was pretty good until Friday, basically, or let's just say mediocre given everything going on. And starting Friday, we started to see this pretty big slide with some pretty big drops day to day. So, it's been a volatile week or so here on what is typically a little bit lighter trading week ahead of the holiday. So, we've seen a big drop here. We're kind of at some important resistant levels with the S&P today around 3,900. So we will see what is ahead, especially after a long weekend to kind of recoup and see where we land. Plus an important, very, very important number coming out tomorrow, which I'll touch on here in a bit. Going back to last week, we had PCE price index up 0.1%, spending up 0.2%, nominal income up 0.2%. So the story that we kind of gathered, I guess, on Friday outside of the Fed was that the consumer is still strong. So this is good to see. But again, with the Fed comments out at Jackson Hole, the markets are concerned. The odds of a 75 basis point hike are now somewhere around 70%, I believe, which is quite a jump from where we were before he had talked on Friday. But the big focus right now is jobs, right? So we still have the jobs data coming out tomorrow, and then we have another inflation data point coming out before the Fed actually makes their decision coming up in a couple weeks. But basically, on Wednesday, we had job openings come out, which was 11.2 million. Huge jump from the 10.3 we saw just last month. Maybe more importantly, we also had ADP employment report come out for the first time after a couple month hiatus, and saw 132,000 jobs added. This was way below the expectations of around 300,000 or so. Now, for those who pay attention and follow our comments here weekly, you know that just a couple months back, we didn't really look at the ADP employment report all that heavily because the non-farm payrolls is typically a little more accurate and a little bit, better sense of what's going on. That said, they've tried to revamp it, so we'll see how accurate this may or may not be. And again, it's a bad sign for what we're all looking forward to see what comes out tomorrow. Tomorrow, we have the non-farm payrolls number coming out, and this is extremely, extremely important to watch because if the number is not as high as expected, we may see the markets breathe a little bit. If this number actually shows that there are some challenges with the labor market, likely what we'll see is the markets breathe a little bit, thinking that maybe the Fed will not be as aggressive, or at least that there's some concerns for the Fed to be aggressive. Now, if it is better than expected, if the labor market is showing continued signs of strength here, the concern is that we're likely in for a little more volatility because the market will see this as the idea that the Fed is going to be aggressive. They're not going to be concerned about the impacts to the labor market, which is a big factor in what they watch, and may get much more aggressive, not only just in the coming meeting, but also what they kind of project moving forward. All that said, another thing to kind of consider is that if this number actually comes out negative, the recession talks that we've been spending a lot of time on lately become much, much more real. For those who don't know, we don't necessarily feel that we're in one today, but we do see one coming. And part of it is because the labor market has been really strong. Now, if we see that for whatever reason on Friday, the jobs number is negative, that conversation becomes much more real moving forward. It is very unlikely, to be very clear, that number comes out negative. It's much more likely that it's either slightly less positive than expected or more positive, which is where the Fed will factor in. But nonetheless, important to watch for sure. So coming up next week, obviously we'll break down the jobs number on Friday. We'll talk about what that means. Short week, again, Monday's closed for Labor Day holiday, so I hope you can enjoy it. But we'll be right back next Thursday to talk about what we're seeing in those few days since, and what the jobs number tomorrow really meant for the markets and the impacts moving forward. Before we break for the holiday, I do want to touch real quickly on a question of the week, which is a great one from Jeff. So Jeff, I really appreciate you reaching out on this, and certainly excited to answer your question. The question from Jeff is basically what sectors to consider right now. What sectors in the market may be worth looking at? And I think one broad way to look at things is right now, we've moved, going backwards the last 2 years, it has been goods that have done very well. So during the COVID time when things were shut down, Amazon, right, all these online companies, or even the big box stores that were allowed to be open, were selling like crazy. I mean, that's really where the consumer was going. Now we switch gears. We're in an entirely different world, and what I think is maybe important to look at is things like services, right? So actually, this is something that I heard recently at a conference that I attended, which I thought was really helpful. But as we move forward, that there's likely to be a transition from goods to services, which we've already started seeing. If you think about things like travel, things like professional services, right? Those types of areas, that's where we may start to see a bit of a transition. Now, to break that down maybe a little further, we also want to look at assets or sectors that may have some strong assets, strong balance sheets, some fixed costs. And really, if you think about it that way, it's again, a little bit of a flip of the switch from what maybe had worked so well before. So here it might be things like energy, which obviously has done very, very well so far this year. Industrials, manufacturing, maybe some healthcare in there. So obviously I'm speaking very broadly. Please, take this with a grain of salt and make sure you're looking at these things properly. But I think that the shift has already happened this year and likely is going to continue in terms of what had worked and what will work. So hopefully that is helpful. Jeff, again, I think great questions. So really happy that you shared that today, and hopefully this is helpful to everybody listening as well. For now, we'll break. Have a great holiday weekend. Hopefully it will be sunny around here, and we will see you next Thursday at 3 p.m.